What unexpected closing costs come with different loan types? Imagine you're about to sign the papers on your new home, but suddenly, surprise fees pop up that you didn't see coming. That's why understanding closing costs is so important. When you buy a house, closing costs are the fees you pay at the end of the deal. They usually range from 2% to 5% of your loan amount. These costs can vary a lot depending on the type of loan you choose. Some costs are common to most loans, like lender fees, which cover credit reports, loan applications, and processing. These fees are legally limited to 3% of your loan amount. You also have third-party costs like property taxes, title insurance, and homeowner's insurance. These are often not included in initial estimates and can catch buyers off guard. Now, different loan types come with their own unexpected costs. For example, if you get a conventional loan, you might need to pay private mortgage insurance if your down payment is less than 20%. This insurance protects the lender but adds to your monthly bills and can include an upfront premium at closing. With a conventional loan, you also might see loan origination and processing fees, which are administrative costs that can be around 0.5% to 1% of your loan. Prepaid interest is another surprise. It is the interest that accrues from your closing date until your first mortgage payment. The later in the month you close, the less prepaid interest you'll owe. Some loans allow you to buy points, which are upfront fees to lower your interest rate. Paying points can add thousands to your closing costs but might save you money over time through lower monthly payments. You could also encounter escrow fees or attorney fees, especially if your state requires legal representation or escrow services during closing. Appraisal and inspection fees are common too. Lenders want to verify your home's value and check for issues before finalizing the loan. These are usually paid at closing or before. Transfer taxes or documentary stamps are taxes on property transfers that some states or localidades charge, adding to your costs unexpectedly. Now, looking at specific loan types, a FHA loan, which is backed by the Federal Housing Administration, often requires an upfront mortgage insurance premium and ongoing mortgage insurance payments. These costs increase your closing expenses. VA loans, which are available to veterans and active service members, typically do not requiring private mortgage insurance, but they do have a funding fee. This fee can be paid upfront or rolled into your loan, and it helps sustain the VA loan program. No closing cost loans are another option. They do not eliminate closing costs but instead roll them into your loan balance or increase your interest rate. This means higher payments over time but less cash paid at closing. For Asian American homebuyers, it is smart to carefully review your loan estimate and closing disclosure documents. These will list all fees, so you can compare and plan accordingly. Timing your closing toward the end of the month can also help reduce prepaid interest. You might also look into assistance programs like grants or forgivable loans offered by local or state agencies. Negotiating with sellers to cover some closing costs is another strategy, especially in a buyer-friendly market. Working with lenders and real estate professionals who understand the financial challenges specific to Asian American communities can help you avoid surprises. Knowing what unexpected costs might come with your loan type helps you plan better and avoid surprises at closing. Being prepared makes the process smoother and helps you move into your new home with confidence.